Welcome to today's market report.
World stocks plummeted again on Thursday and government bonds hovered near multi-year highs after a series of rate rises from global central banks rekindled fears that aggressive policy tightening could drag economies into recession. Following a relief rally on Wednesday when investors welcomed the US Fed's aggressive move to raise rates by 75 basis points, its biggest rate hike since 1994, by buying shares. Two other spates of policy tightening in Britain and Switzerland seemed to have sobered investors into focusing on the chance that economies could slow as rates rise. Can the economy take it? So far, leading indicators show good readings, but we remain worried of a consumer strike. MSCI's gauge of stocks across the globe slumped 2.25% to hover near a 19.5-month low. The Dow Jones dropped 2.5%, the S&P shed 3.3%, the Nasdaq slumped 4.1%. All three indices were trading at their lowest in at least 1.5 years. The dollar, which has benefited from rising US yields, flagged on Thursday, weighed in part by the Swiss franc, which surged after Swiss National Bank surprised investors earlier in the day by raising interest rates for the first time in 15 years by 50 basis points. The Bank of England also lifted rates on Thursday for a fifth time since December by 25 basis points, a day after the European Central Bank promised support to temper a bond market rout filled by hawkish expectations. The Swiss franc dragged the dollar index down 0.95% to 103.8, pulling it from a 20-year high of 105.79 struck on Wednesday. The British pound is rallying sharply following a 25 basis rate hike by the BOE, which now plays catch-up versus the US Fed, hitting the 123.50 level, up 1.47%. Eurodollar shifted positively in the week and is gaining 0.34%, soaring sharply above 105 for the first time in the week.
This is today's market news. Thanks for listening. We'll see you next time.